Hi everybody. Welcome to my video series in accounting. I'm going to start a series of videos on this channel to teach you guys the basics of Accounting 1. And today I'm going to start with teaching you guys about the annual report and how to prepare the financial statements. I'm Dr. Ashley Braun Harper, CPA, and I hope you enjoy this presentation. So let's start off. For those of you who may not be familiar with what an annual report is, an annual report is a document issued by every publicly traded company. They have to issue it once a year annually to the SEC, and they also usually publish it online on the company's website. So within this annual report are several items. So we're going to talk about each one of those. The first one is called the MD&A section, and this is called the Management Discussions and Analysis section. And this can be a really long part or it can be short, but this is where you have your top management, the CEOs, the CFOs, the CIOs, COO. They're all talking about the company and its future, how it looks, what maybe new products are coming about, expansion opportunities, and it also will have different things such as your financial ratios, where they explain why a certain ratio is acting a certain way. So that's called the MD&A, and usually that's in the very front of the report. The meat and potatoes of the annual report, which we're going to talk about in this lecture, are your financial statements. So that's what we're going to learn how to prepare today. So there are 4 of those, and I'll go over those on the next few slides. Then there is the notes to the financial statements. The notes to the financial statements can also be pretty long, as it's all of the supporting details backing up those financial statement numbers. So in this area, you'll find such as things like the loan interest rates that a company may be having on some sort of debt, what inventory methods they're using to calculate their inventory, what depreciation methods they're using. Anything that an investor or a potential user of those financial statements needs to know to make a decision on those financial statement numbers, that information will be backed up in the notes. There will also be something called an independent auditor's report. This report is done by a publicly, a public CPA firm. They come in and they look at the statements and they review them, and they have to sign off, on the statements along with management. So this is also found in there, basically stating to the public, hey, can we rely on these, these statements or not? Also, in the annual report, there's other information, pictures, and maybe pictures of, the officers, employees, products, different graphs, anything that the company wants to show to the shareholders of the organization. So we're going to be talking about the financial statements since this is accounting. So there are 4 that are required in the annual report. Now sometimes companies may name them a little different. When you're first learning the statements, we call them, these 4 terms, basically for simplicity. But the first one is the income statement. Then we have the retained earnings statement, the balance sheet, and the statement of cash flows. And they're listed in this order for a particular reason. They have to be prepared in this order because each statement uses information from the prior statement to be prepared. So you can't reverse the order and prepare them, the statement of cash flows first. So you have to have all the other statements prepared before you do a statement of cash flows. So we'll start with the income statement. So the income statement, sometimes you may hear it called a P&L statement or a statement of operations. They're all the same thing. What this statement does, it reports a company's operations, the results for a period of time, like a month, a quarter, or a year. The basics of this statement, real simple. You take all of your revenues or your money coming in, minus all of your expenses, your money going out, and that gives you what we call the bottom line in accounting. Now, the professional term for the bottom line is your net income or net loss. So net income is also known as profit. Okay, net loss is your, loss. So the official accounting term for profit or bottom line would be net income. Okay, the next statement, we're just going to talk about each one and I'm going to show you how to prepare them, is the retained earnings statement. So at the end of every period, the corporation has to decide out of the profit or the net income that they made, how much do we want to keep in the business and how much do we want to pay out shareholders, okay? If any, they don't have to pay out dividends. Those are called dividends when they pay out shareholders. So this statement will show the changes in the retained earnings during the period. So the time period would be the same as the income statement, a month, a quarter, or a year for a period of time. So you start with your beginning retained earnings. So if you're a new company and this is your first, year of preparing financials, that would be 0. Okay, so a lot of times it'll be a new business. But if you're an ongoing company, it would be your ending retained earnings from the prior year. So you start with that. You'll add your profit or your net income, or if it's a loss, you'd subtract it from that balance of retained earnings. And then if you paid any dividends, you'd subtract those. And that'll give you your ending retained earnings. Okay, it's as simple as that. So you see how the net income is plugged into this particular statement. It's pulled over from that income statement or subtracted if it's a loss. Now, the ending retained earnings is also going to be the number that we carry forward into the balance sheet. I'm going to show you when we actually work through a statement how that number is plugged in. So the third statement is the balance sheet. So this statement is going to show your assets and your claims to those assets at a particular point in time. So a snapshot. So it's at a specific date in time, not a period like a month. So you're going to have all of your assets, which are your resources owned by a business. And we'll talk about them when we look at a balance sheet. But, those are things such as your cash and your inventory and your equipment. And then on the other side of the balance sheet are the claims to those assets. And we divide those into 2 categories. You have your claims of your creditors, which are known as, in accounting, liabilities. So liabilities, equals synonymously with debt. It's your business debt. That's a fancy way of saying business debt. It's a liability. And then we have your claims of your owners, which is your stockholders' equity. Okay, and that is going to be divided up into 2 further categories called your common stock, which is their initial investment into your company, and then your retained earnings, that's ending retained earnings, what your company has earned, okay? What you're keeping in the business. So this statement actually, if you break it down, it looks like the basic accounting equation. Your assets equal your liabilities plus stockholders' equity. So when you're preparing this statement, if it doesn't equal, if your assets don't equal your liabilities plus your equity, you did something wrong, and you got to go back and find your mistake. So again, we'll be talking about the basic accounting equation in a later lecture when we get into debits and credits. And finally, the fourth statement, which is usually saved for an upper level accounting course, is your statement of cash flows. This statement is also known as one of the most important statements because it deals with a company's most important resource, which is cash. And it's also going to be done for a period of time, like the income statement and retained earnings statement. So I'm not going to go into detail and show you one of these statements in this particular lecture, but I will say that the categories in each one of these areas, you have operating, which would be your profits, your inflows and outflows of cash for your day-to-day operating activities. And then you would show your investing activities, which would be did I buy some equipment? Did I sell some equipment? That would go in that category. And then you have your financing activities, which would be, did I acquire debt? Did I pay debt off? So this statement will break all of that down, but it only deals with cash inflows and outflows. So, but know that it's a required fourth statement, and it is prepared last. So let's go ahead and create some statements. I'm going to show you how they are tied together. So the very first thing for every statement that you prepare is you have to put the heading on the statement. And for those of you that ever take the CPA, they require you to put the heading on. Okay, major point deductions if you don't put the heading. So what is in the heading? It's the corporation's name, of course, the name of the statement that you're preparing, and then the time frame that you're covering. So for an income statement, retained earnings statement, or cash flow, it would look like the first bullet point there for the month ended January 31st and then the year. But if you're doing a balance sheet, it's going to be a specific date. So January 31st of 2019, okay? It wouldn't have for the period ended. So that would be the difference for that statement. So let's look at the income statement first. So this is fictitious. I'm going to name my corporation Ashley Corporation. So I have my name, my income statement for the month ended January 31st, we'll say 2019. So income statement, you start with your revenues. So I'm going to start with my revenues. I'm going to list all the sources of revenue for my company. So for each business, this could be different. So we'll start with sales revenue of $5,000 if I'm selling a product. I could also have interest revenue from maybe, an investment, and also service revenue if I provide a service. So I'll add up all sources of revenue that I've earned, okay, and I'll have a total revenues of $10,000. Okay, most likely a company would have one of these, not all three. They may have interest, but that may be, later down the road. But I'm showing you all the different types for, just educational purposes here. So we have $10,000 in total revenues. Then we're going to subtract all of our expenses. Again, these expenses vary. So these are just some common expenses for businesses. Cost of goods sold, $1,000. Selling, marketing, and administrative expenses, $500. Interest expense, $100. Income tax expense, $300. And depreciation expense, $100. So I'll add up all those expenses and I get $2,000. Okay. So simply deduct them from the $10,000 and that gives me $8,000 of profit. Net income, $8,000. I'm in the black here, so that means I have a profit. So I'm going to take that $8,000 and I'm going to transfer it to the next statement, which is the retained earnings statement, the bottom line. So same thing, I'll start with my heading, Ashley Corporation. This is a retained earnings statement for the month ended January 31st, 2019. We're going to start with our beginning retained earnings at the beginning of the year. So this company is an ongoing company, so I'll start with $13,050. I'll plug that net income of $8,000. I'll add it here. So that'll give me $21,050 of retained earnings. I'll have to check and see, did I pay any dividends during the month of January? And I did, $1,000. So I'll subtract those out. So again, a company doesn't have to pay dividends. So that leaves me with ending retained earnings at the end of the month of $20,050, and that is the amount that I'll transfer to my balance sheet, okay? And this is just a little tidbit about dividends, okay? They're payments that the corporation would make to their stockholders, on a regular basis if they have sufficient profits, okay? They're not required to by law, but it's a good, it's a good practice to keep the shareholders happy. Okay, the third statement and the final one that we're going to cover in this lecture is your balance sheet. Again, the title of the corporation, your balance sheet. The date is a specific date, January 31st, 2019. All right, so this is half of the balance sheet. Okay, I couldn't fit it all on one page because this is a classified balance sheet. What makes it a classified balance sheet is that I have subcategories. I have all those subcategories in blue there. Okay, if it were a regular balance sheet, you wouldn't have the blue subcategories. So this is just the asset section. When I get to the next slide, it'll be the liabilities and equity section. So first we're going to list our assets. And here I group them into current assets, which are always listed first. And they're also listed in a particular order. They're listed in the order of their liquidity. What does that mean? That means how quickly can I convert this asset into cash? So of course, cash is the quickest. So cash will always be listed first, okay? Followed by short-term investments, accounts receivable, inventory, supplies, prepaid expenses, and other assets. So I'll add up my current assets, and again, they're going to be used within a year. That's what classifies them as current, okay? And they're also listed in their order of liquidity. So those current assets total $22,100. Next, I will list some of my longer-term assets. I can have long-term investments, such as an investment in the stock of another company. So I have that there, $7,200. I also have property, plant, and equipment. So I have some land valued at $14,000. I have buildings and equipment valued at $10,000 minus what is depreciated on that, which is $5,000. So the book value of that building and equipment would be $5,000. We'll get into that in another lecture as well. So my total PP&E, that's an abbreviation for property, plant, and equipment, $14,000 plus $5,000 will give you $19,000. So we have one more here on this particular sheet. Again, they vary by company. Every company will have different assets on their books. We have some intangible assets, and intangible assets are those assets that you cannot physically touch, okay? They are very valuable assets for a company, such as your patents, $1,000, and goodwill of $2,100. Goodwill, a lot of people don't know what that is, but that you have goodwill in your books. If this company has bought another company, which they have because they have goodwill in the books, that is the value of all the favorable attributes of that other company that they bought. And you can't really, put it in a specific category because it's intangible. You can't touch it. It's like the customer base. So it's set, it's a price because it's the excess of what they pay to buy that other company over its net present value. Okay, so that would be the excess of the purchase price that the company that's buying that company has paid for that company, which is the value of all its favorable attributes. So that's what that is. It's intangible. So we'll add those up. It's $3,100. Let's add all of our assets up, and we get a total assets of $51,400. And then that number has to match our liabilities plus our stockholders' equity. So let's see if it does. So now we have our liabilities and stockholders' equity. Okay, again, like the asset section, we list current liabilities, and these are liabilities that are going to be paid within 1 year or less. So we have notes payable, we have accounts payable, interest payable, unearned revenue, which, yes, it's a liability, even though it says revenue because it's unearned. Okay, you haven't earned it yet. Okay, they paid you in advance, and you have to, recognize that it is a liability until you provide that service. We have salaries payable, we have accrued expenses and other liabilities. So if we add them all up, we'll get total current liabilities of $16,050. We'll have long-term liabilities like a notes payable, a long-term note of $1,300, and that'll add in with the $16,050 to give us total liabilities of $17,350. Okay, so that's one part of that side of the balance sheet. We have to add our stockholders' equity. So we'll add our common stock, which is the initial investment that our stockholders have paid for the corporation or to start the business, which is $14,000. And then we'll plug in that ending retained earnings number. So that was, if you go back to that slide, that ending retained earnings was $20,050. So that's where you plug it in. Now, I'm going to say this. I see so many students make the mistake of plugging the beginning retained earnings number there and not the ending. It'll make your balance sheet off. So always use that ending number. So my total stockholders' equity is $34,050. You add that to your total liabilities, and you'll get total liabilities and stockholders' equity of $51,400, and it matches my assets. So the balance sheet balances, and we're done. So now you can move on to the cash flow statement. But again, that's taught in a higher level course. So what are some uses of the financial statements? So now that you've prepared them, how do you use them? So both internal and external users use financial statements. Internal users are your officers, your managers, and your supervisors. Okay, they use these statements to make budgeting decisions and plans for the future and so forth. And then you have many external users because they're these financial statements are being published to the public. You have your investors, your shareholders, your creditors, the IRS, regulatory agencies such as the SEC, and your customers even look at them. Okay, so they're used by a lot of folks. So what they do is they not only read the financial statements to see, you know, how much profit they made, but they use ratio analysis to help understand the relationships among the financial statements. So we divide these ratios into different categories. So we have liquidity ratios, which I've already, you know, made mention of that term. This is the measure of the short-term ability of a company to pay its obligations and to meet needs for cash. Okay, it's the short-term ability, okay, to pay off its bills, basically. Okay, how liquid is this company? Okay, then they have profitability ratios, which measures the income or operating success of a company for a period of time. How profitable are they? And then we have solvency ratios, which measure the ability of a company, you know, to survive in the long term. You know, looking at their long-term debt. Are they going to be able to pay these long-term debts back? So these are, you know, some of the ratios, but I'm going to go over a few of the ones that are, you know, kind of popular. But a ratio, like just to calculate a ratio, is really meaningless. You have to have something to compare it to. So you either compare it to the industry average, you know, what are other companies, you know, in that industry doing, or the competitor of your particular company. That's known as intercompany. Or to your past year results in your company. That's known as intracompany, to see how you're doing against, you know, say last year's data or the year before. So you want to have something to compare it to. Okay, so here's some examples of the three categories. There are more. Okay, there's tons of financial ratios out there. So the two most popular liquidity measures are your working capital and your current ratio. So here you'll use both the current assets and current liabilities figure. So I did pull the numbers from the financial statements that we just prepared, you know, to go ahead and calculate these ratios. So if you look at the current assets from the balance sheet was $22,100, and then we had current liabilities of $16,050. So that gives us a working capital of $6,050, and it's positive, which is good. The higher, the better. You don't want it to be negative. You don't want your current liabilities to be more. The current ratio is a more dependable indicator of liquidity. It just takes your current assets and divides them by your current liabilities. So here we do the same thing. What we would get is an answer of 1.38, and we set that to 1. So the higher it is, you know, above 1, the better. You don't want it to be below 1, okay? So it says for every liability, there are 1.38 assets. You want that higher. Okay, for the profitability measures, the profit margin ratio is very popular, and that's your net income divided by your net sales. So for this example, we would pull that off of that income statement, and we had $8,000 of net income divided by $10,000 of net sales, and that gave us 80%. Well, 80% is very high, extremely good. So that means 80% of all sales will result in profit for the company. Again, the higher, the better. The earnings per share, you may have heard this, EPS, it's a very popular ratio, is also a profitability measure. It's the net income divided by the average number of common shares outstanding. Now, we didn't have that information provided here, but that's how you calculate it. And the higher the EPS, the better. So it's a very useful tool. A lot of people, you know, shareholders, investors will compare companies' EPS against one another. Okay, the one solvency measure I'm going to mention is your debt to total assets ratio. So here you're going to take your total your total liabilities divided by your total assets. So it's not the current, it's the total as a whole, measuring long term. So it's $17,350 of total liabilities divided by $51,400 of total assets to give us 34%. So you want this ratio to be low. The lower the better. It means that 34 cents of every dollar is invested in assets has been provided by your creditors rather than your stockholders. Okay, if it starts getting too high, it could, you know, be a risk that the company might not be able to pay its debt as it comes due. Okay, a little bit of accounting lagniappe for you. Lagniappe is just miscellaneous information. We use that term in itself. That GAAP, G-A-A-P, if you've heard that acronym before, it stands for Generally Accepted Accounting Principles. And what this is the set of accounting rules that has the support, in the profession, in the discipline, and is recognized as a general guide for financial reporting. So they're set by standard-setting bodies and in consultation with the accounting profession and the business community. So everything, like all the rules, the why we do what we do in accounting is because there has been a GAAP rule that tells us that's what we have to do, okay? Now, there are a couple of constraints in accounting that allow a company to modify GAAP without jeopardizing the usefulness of the information. And this is a judgment call. And there are two constraints that we're going to talk about are materiality and conservatism. So materiality would come down to, would you depreciate a paperclip? Okay, is a paperclip an asset? Well, yes, technically. Is a car an asset? Yes. But why would I depreciate and go through accounting and go through allocating its cost over, 10 years or whatever because it cost, under, 10 cents, okay? No, that's called materiality. You're only going to want to do that, those depreciation methods, for assets that are material, okay? That are, going to have some sort of value when you do fully depreciate them and then eventually get rid of them and sell them. The other one is conservatism. And this rule states that when in doubt, never overstate assets or revenues and never understate expenses or liabilities, okay? When in doubt, okay? There's a judgment call. That's the thing. You don't want to inflate revenues. You don't want to inflate, your assets. And then you don't want to understate those liabilities and expenses. So that's the conservatism rule and that they have to follow. So it's a lot of it's judgment and a lot of practice. Now, who sets all these rules and standards for the profession? Okay, well, the FASB, it's another acronym. It stands for the Financial Accounting Standards Board. It's the primary U.S. accounting standards body, and they rely on key assumptions and principles as well as characteristics to set all the standards. So these are some of the assumptions that they use to set and write all of GAAP. So the monetary unit assumption, this one says that if you're going to report, your annual report and your financial statements, that you have to report in dollars, okay, if you're a U.S. company. The economic entity assumption, okay, is that your company is its own entity, okay? And it's taxed like its own entity. It's almost like it's its own person. It follows laws and reporting requirements like its own person. The time period assumption is that you have to use a year, month, quarters. You can't make up some kind of weird, 2.5 month reporting. You have to follow what's consistent in your industry or in, the particular, company you're going for. The going concern assumption assumes that, if your company, you're going to report as if you're going to continue to operate, and you're not going to report as if you're going to be bankrupt that year. Okay, you want to always report like you're going to still be in business. That's something that you may disclose in the notes, but you don't want to, start reporting that way. You always report as if you're going to continue to operate. The cost principle states that your assets are recorded at historical cost, what you bought them for. You don't inflate them. We don't, raise the value of those on our books. You have to report them at what you paid for them. And the full disclosure principle means that you must disclose anything that an investor would use to make a decision based on those financial statement numbers. When in doubt, disclose, disclose, disclose. Some of the qualitative characteristics in the standards. The information that you report to the public should be relevant, okay? Meaning, it has to be current information. It has to be reliable. You want to make sure it's coming from, a correct source and that the calculations are being done correctly. And that it's also comparable and consistent from one year to the next and from one company to the other. So who oversees the FASB? That would be the SEC, which is the Securities and Exchange Commission of the U.S. So they oversee all the financial markets, such as the accounting standard bodies, such as the FASB. Okay, so the IASB is another organization, the International Accounting Standards Board, and this organization works with the FASB and countries outside of the U.S. that have adopted the standards by the IASB. So this is for companies that are having, operations overseas. They have different standards that they have to abide by. All right, I've enjoyed my first video lecture on the financial statements. Please leave comments and or questions in the chat. And if you like this video, please like and subscribe and hit the bell icon to be notified of future accounting related videos. Thank you so much.